So, okay, well, let's get into it then. Do you want to, introduce yourself and Ethical Futures and talk about, what you do, what your day to day looks like,
Yeah.
and yeah, we'll start there.
Okay. So my name is Julian Parrott. I'm a founding partner of Ethical Futures. Ethical Futures are independent financial planners. We're based in Edinburgh, and we predominantly advise clients across Scotland, but we do have clients dotted around the rest of the UK as well. A financial planner or an independent financial advisor is a regulated advisor who provides financial advice in the context of meeting, for us, in terms of meeting personal clients' lifetime objectives and such like. We've been going since 2005, and the name on our brand just tells you kind of what we're about. We're about putting your money to work in a way that reflects your values, and that can cover a variety of different financial circumstances. Our strapline is make your money change your world. It's intentionally designed that way. It's about helping you plan for the future, for your own future, but to do that in the context of making some positive impact in the world as well. And the business is growing. There's myself and my partner and another advisor and a growing support team who help us deliver that. I think we're now number 9 people in total, which is great.
Yeah, great. I just want to talk through what it looks like for somebody who might be thinking about a financial advisor, getting a financial advisor. First of all, how much money would you expect somebody to have available to invest or save before they speak to you? How much does it cost to work with a financial advisor? And then what would those first couple of conversations look like?
Yeah. It's funny because when you do a job, you just do the job and you just carry on and you know what you're about and who you tend to be talking to and such like. But I do get from clients, certainly prospective clients and new clients, that sort of, it's the first time I've spoken to a financial advisor, or I don't know if you can speak to me if I've got enough money and such like. And surprisingly, that can be really, to my mind, quite a large amount of money that people don't think they've got enough to speak to us about. The job doesn't limit, and the job description doesn't limit people to getting advice. That's a factor that is effectively how businesses set themselves up and how they present to the market, and what sort of clients they've decided they want to work with, and I'm sure that's for very good reasons. With the name that we've got in the badge of our business, we try to be open to as many as people who want to speak to us. For us, you have to have some care about the world. Perfectly honest, we're happy to try and persuade people to be more careful about what their money does, but we're not going to advise you if you want your money in a mainstream investment portfolio that doesn't take any cognizance of social investment considerations, etc. So that's the sort of basis for us. There are economic conditions and there are economic levels. You're asking, well, how do you engage and what's the first sort of experience? The way that we operate, not everybody will do this, but the way that we operate is, we don't have a drawbridge. You can email us and tell us, how much you want to, what you're about. We'll have an initial chat with you. If we genuinely don't think we can add any value to what you're doing, we will try and point you in the right direction of what we think you can do, and leave you to do that. If we can advise you, then initially, essentially, you'll have an engagement which is about understanding who you are, what your financial circumstances are, and what your objectives and such like are as well. And generally, for many advisors, that level of engagement won't cost you anything other than your time, and that would be the same for us. We do differ as a business from many financial advisors. Many advisors work on what they call an ad valorem basis. If you have an investment amount, they'll take a percentage charge against that to make your recommendation. And they may not actually charge you until you've put some money into a pot and taken a payment from that. We prefer clarity and transparency about what we're about. So we have what we call a project fee for our initial advice. So that's based upon the complexity and the levels of work that you want to do. Some people present with a relatively straightforward scenario, some people a little bit more complicated. And we have component parts of the advice, and we'll charge according to that. Before you engage us, you'll get a letter telling you exactly what the cost is, and that's what we will charge. So that we just feel that's nice and transparent. You then have options beyond that if you want us to be providing you with ongoing advice. The one thing I think you do need to bear in mind is when you come to a financial planner is you need to be open. You need to be telling us about your circumstances. We're very mindful of your data privacy and the trust in which you hold us in, and you share personal financial detail and also perhaps personal aspects and things about your life. But you need to tell us, because information is all. We're an information business. We need to gather information so that we can impart the right information back to you.
And so the reason why I'm speaking to you is because you have a special interest in ethical investment, as you were sort of just alluding to. So what does that mean for you, and what does that mean that you do that makes it different to kind of regular advisors?
Yeah. So it's a good question, and the world's changing, and more regular advisors are being able to do values-based or ESG or responsible ethical investing. So they have that choice, and we have to think about what that means for us. I mean, I think first of all, what it means for us is that if clients are speaking to us, they're speaking to a kindred spirit. They're speaking to somebody who actually believes that there's some purpose and objective in what they're trying to do. So they're going to have there's a degree of empathy in that approach. So we didn't set the business up just because we thought it was a niche and we could play about with it. We set it up because we believed it. We wanted to reflect that in our practice. So that's first and foremost. We have been going for quite a long time. We have developed quite considerable experience in understanding the different streams of investment and styles and approaches, and indeed have built up very good relationships with a lot of people in the financial services community. That I think comes through in terms of knowledge and understanding, but also that what we probably do that's different is to help a client navigate what is a complex world. So the market has evolved lots of different styles and approaches to investing, which we are happy to call ethical. And ethical for us is an umbrella, and it's an umbrella which we feel that the general public, the retail client, sort of understands what it means. And then we can unpack that with people individually to understand exactly what they're looking for and where the options and limits are. And I suppose we will probably move beyond beyond sometimes traditional investment structures for clients. We will certainly, even if we don't give them what you would call regulated advice, we will certainly give them planning advice on how they can step out into the world of things like community investing and social enterprise investing and such like as well. So we look at a very wide range in the area.
Yeah. Are there any kind of particular issues or themes that people raise when they're asking for ethical investment options? Is there, I don't know, climate change or some kind of aspects of nature or some other kind of social issues? Which one seems to be really popular?
Well, it's changed. We did a survey just before we started doing client surveys, but kind of prior to COVID, and then because we had an intern to help us to do that, and we're going to return to doing that because we gather quite a lot of information, and we do some ad hoc sort of polling of clients on issues. So we did one last year on China and involvement in that market. It's definitely changed over time, but there are still sort of steadfast areas around it. Probably 10, 15 years ago, there was a bit more strength around, or emphasis, I suppose, on human rights and social issues. I don't think those have fallen away. I'm very happy to say people still see things like armaments and human rights and such like as being areas of concern in terms of what they're involved in, but certainly climate change has moved right up the agenda. I think it's perhaps that becomes quite well. It's obviously a current issue and probably the most existential issue for us in the globe. So people, the media are picked up, and therefore people are aware of it, and therefore that's an issue. Understanding, again, it's all about unpacking for us as to what that means. Equally, some people come with very precise things. So, and I think what we do find is it's quite easy to say I don't want, and you do get a bit of that, and it's mostly about either human rights, labour standards, etc. The do wants sometimes come in terms of I'd like to be investing in renewables, or I'd like to be doing something in that area. But the climate change area is probably the umbrella for that sort of environmental concern now. The don't wants, probably fossil fuels, is come right up in the last 5 or 10 years as well as an exclusion. So people and I suppose that's why the job that I do is quite rewarding, because we actually work with people who are quite engaged. They've actually had a thought. They've wanted to go and progress with investment. They've maybe had a wee dip into the market themselves, and they're a bit uncertain as to whether or not what they're doing is right, or if A or B is really doing what it says on the tin, sort of thing.
Mm-hmm. And in the industry, so people working in finance and investment, these types of topics are becoming, it feels like it's kind of mainstreaming right across the industry. Yeah. Everyone's talking about sustainability and ESG, environment, social and governance, and ethical and impact. I mean, it's just everywhere now, isn't it?
Yeah, it is.
How is that translating into the real world? Are you seeing more kind of client demand for this stuff? And do people outside of the industry who might not know all the nuances and all the different strategies, do we still need to kind of convince them that ethical investment is a good idea for the world and financially?
Yeah, I think for you and I, Charlene, we've been imbued in it over the years of being involved in the market and the sector and working with people. So we understand that lingo, and I've been at a number of industry events where I've sort of I quite often try and stand up for the retail investor sort of thing, to say that well, you can talk that speak, but it doesn't necessarily translate. So that is probably some of my concern. I mean, I think to address the thing is, has there been an increase in demand and interest? Yes, definitely. You could call it the blue planet or the Greta effect. Those leading up, certainly building up to COP, but pretty good evidence to say that people still hold their values even in light of what we've experienced in the last 12 months or so, 6 to 8 months or so with Ukraine and global issues. Yeah, that did unleash, a much greater interest. In a way, it's a bit harder for somebody like me who works in the market as a specialist, and therefore, to a certain extent, has self-selecting clients who come because they have a particular value set. We've been busier, but is that just because we're a growing business and more people have recommended us because we seem to be doing a good job, or is it because there's a sea change in that? I think the measure I would say for that, which I find most useful to assess how we're doing, is that the number of my peer group who now engage or find that they now have clients who engage as well. So literally when I did this, when I started doing this job and I told people what I did and I confirmed the qualification that we didn't do any mainstream investing, I mean, people thought I was bonkers. I mean, literally they couldn't understand how I could earn a living, which is great. I was happy for that to carry on because ultimately it served me well over the longer term. But not really, because actually I wanted to get more people out there. So that I've done various things to try and work with my peer group to encourage them to think that it's not that scary to work with clients, and the clients can be served well by the investment. I think there's an element of people starting to understand some of the sort of more technical and nuanced aspects that are coming through in the market, but I think essentially it still comes down to relatively binary positions of I don't want and I do want, and those are not necessarily voiced in an ESG investment or a responsible. The industry has been it doesn't really quite like the word ethical. It's loaded with too many connotations for them, so they tend to look for words like stewardship and responsible and sustainability, which even the regulator, the FCA, is having a hard time trying to understand what that means. So they clients want to know what that means, and that I think is where sometimes you get the issues of greenwashing and people understanding they put onto an investment a set of expectations, and it's important to understand what's there. But yes, those. I mean, on a survey that we did do fairly recently, people were interested in things around governance and such like, and things around engagement with businesses. What we do when we talk about what investments do, we talk about the avoidance and the positive and impact and such like, but we also talk about activities like engagement, and that's a bit of a hidden secret that people don't really understand. And I'm very much about trying to talk to people about leveraging the power of money, and that if you put your money in the hands of a manager who's active and engaged with businesses, then you can make incremental change, and I think that's worthy of doing. I see lights and eyes, when I talk about that, it's because they don't really think about that aspect of it. It's the boring bit in a way. It's harder to communicate. It doesn't sit very easily with a picture of a windmill on a brochure or something like that. But it is something that people are interested in once you sit to talk to them.
Yeah, and before we move on to the questions from members of the public, where do people find an ethical advisor? I think it's one of the questions that does get asked the most.
Yeah,
one of them.
Yeah.
Where do I go? Who do I trust? And it does seem to be a bit tricky. Where would you point people to?
Well, I would direct people to UK Sustainable Investment Association, UK SIF. They have a directory of advisors. There is still technically a subgrouping within that organisation called the Ethical Investment Association. And there's still a live website, although the directory is now mainly on the UK SIF site. And that will give you people who've signed up to UK SIF and believe in the principles of what they're trying to do. UK SIF is an industry body, which Charlene know very well. We're involved with them, but it's an industry body who speaks to the industry and lobbies for in the sustainability world to try and work on developing policy and awareness around a responsible and ethical investment. So that's a good starting point. Points of referral are always a good place. So if you have people who've had some experience, then that's fine. It's certainly how a lot of clients end up at EthicalFutures. If you tap in ethical investment onto a Google search, you'll probably find all sorts of things, and probably go on to the second or third page. If you go in Scotland, you'll probably find us, actually, but if you put in Edinburgh or Scotland. But it's hard. I mean, there are various directories. Warning: directories are paid for in most cases. There are certain criteria push certain people to the top of those directories. So there are areas around that, but I think UK SIF is probably the place I would start.
Yeah, no, good point. And then I would always say, don't just take it all at surface level. Probe the advisor, ask some questions.
Definitely, and speak to 2 or 3. I mean, we do get that. We do get that from time to time, and we're more than happy to do so. And I'm happy to say that people quite often come back to us, but it makes sense. It makes sense to engage if you don't, because it's ultimately quite often a personal relationship. So that does help.
Great. Okay, well, let's move into the questions then that people have sent in.
Yep.
I'll just run through them. So the first one is, how much better in terms of rates are ethical financial products?
Okay, interesting. Well, rates. What are rates? So, rates of interest on a deposit account, or the rate of return. Honestly, not necessarily any better or worse. I think that's not supposed to depress you. It's just supposed to say that there's not necessarily a cost to you making that decision. In the savings market, there are a number of players who go out there and try and meet the best buy tables, and some of them actually will be quite values led. There's a number of particularly Islamic faith Sharia based organisations who often have table topping rates, but it depends on what the business wants to do in terms of its activity. I suppose what I'd say is there's a social dividend sometimes from having your money more positively invested as well. In the investment market, your returns really are reflective of how your business and how your investment portfolio is structured. We have certainly had times, the last 5 years or so, we've probably enjoyed a period of time where sustainable investments have, for the larger part, considerably outperformed mainstream investment funds. Right now, in the middle of 2000 or late end of 2022, we're experiencing a time when oil and gas and tobacco and various other things are more in favour, and many of our funds are struggling. You need to take a sort of 5-year view on investment funds, and there shouldn't be a disadvantage, but with a properly structured portfolio, and hopefully there is some positivity, but I don't think it's all about rates.
Yeah, and you just said it there. Take a 5-year view at least.
Yeah.
Things go up and down all the time.
Exactly.
Okay, so next question. Which financial product do you wish more people suitable for them took advantage of?
Interesting. I think, probably fairly plain vanilla pensions and ISAs, I suppose. Pensions, because sometimes you get this thing about, pensions are rubbish, and people have perceptions about pensions. Just matters of economics, their structural approach, and the fact that you get tax relief and tax advantage growth for a long time mean that you have a reasonable amount of potential of making a good return, but you have to accept there can be a lack of flexibility. So it's a horses for courses type of thing. The ISA is sometimes, because we have fairly generous tax allowances in the UK for smaller investors anyway. For cash, it probably is not so relevant these days. In fact, many cash ISAs are probably paying you lesser rate than you can get on an ordinary savings account, and you can earn £1,000 a year in interest if you're a basic rate taxpayer, irrespective of whether it's an ISA or not. Tax-free, sorry. But for stocks and shares type investment, it costs nothing generally to have it wrapped around your investment, and it provides you with an opportunity to grow and grow money. Probably there's a bit of a left field one, but for the right people who really think about it and what they do with money, and bear in mind that regulatory perspective would say that this is probably slightly higher risk. There are a range of other investments which are relatively available at relatively small amounts of money on platforms that specialise in community and social finance, and I really quite like the idea of not just everything being focused on the main market, but also being focused into sort of developmental and sort of, if you like, an alternative economy of social finance. Quite often there's accessibility on these investments from sort of £250 or £500. So you don't have to have a lot of money, but you do have to accept that they're not protected by the same regulatory standards, and they're generally fairly long term, so they're fairly lock in, but a component part of a broader portfolio.
Oh no, that's I wasn't expecting you to raise that one, but it's a good one, and I've interviewed some of those on this platform as well, so people can have a look at those interviews to find out more. Okay, next question. Given the current level of greenwashing within the industry, what should investors look at to assess the quality of investments?
It is difficult for the retail investor to get as sufficient information as required. From a stocks and shares market perspective, most of the funds which are available will only tell you what's in the top 10. There are managers who will provide you with a full list of the funds if you root around on their websites. That's a good idea to get you to have a look at it. But looking at that alone is not particularly a great basis, because that just gives you the names, and you might come to that with your own perspectives on whether that's good, bad, or indifferent. So I would look, again, it's about who tells you most about what they do and gives you confidence that they actually have a narrative. That's what we look for as an advisor when we're recommending companies. So who has, they will publish this on their website. They will, if they're engaged, put their policies, their procedures. They'll often write articles about thought pieces. They're quite often called about what they're thinking about major environmental, social issues and such like. So it's about perhaps digging in and trying to join up those dots and seeing how consistent is a narrative and how does what they hold reflect that. But there's some hard yards in doing that. But I've always felt that when I recommend funds, that sometimes I might raise an eyebrow at a certain holding, but if I understand the rationale for which the investment manager is applying and deciding that it's fit, then I might have a degree of comfort. I may not make it right for everybody, but that's how we start to understand what one style does and what one doesn't. Increasingly, there's again, a lot of the information. There will be certain providers who put out statements and nice infographics which show impact and what you do and such like. But again, you need to go dig down and actually understand what the methodology of that means. They're telling you they've saved so much water in a year, or created an extra number of education lessons at a school or whatever. You need to understand the methodology of how they've understood it. They've got to that figure because it comes from data providers who crunch the numbers about what businesses do. So it is complex. You could always come speak to a financial advisor who specializes in the area.
Yeah. Okay, next question. How can I build a portfolio of companies with high returns and high sustainability standards?
Okay. Excuse me. Well, I think you need to understand what you're trying to do. I think you need to have a portfolio which is diversified. So it's not all in renewables, or it's not all in something. So understand what actually sustainability can mean in a broader area and broader interpretation, and that can be quite a broad perspective. And again, pretty much like I was saying before, it's about doing some of that sort of hard yards of work. Building portfolios to get high returns. High return equals high risk. So again, it's about structuring an investment portfolio and having an allocation of different types of assets. Equities of different types and styles. So companies, investments in company shares of different types. Different business sectors, business geographical areas, different sizes of activity, but also blending that with loans to institutions, or what we call fixed rate or corporate bond, investments, property perhaps, or infrastructure like potentially renewables, which are productive renewables, which are actually generating energy, and making a portfolio that blends so that because there should be some blend of risk associated by having different assets, and then you will do it. So if you really want to go all out and go high risk, then you will go high equity and high equity content. And the industry labels funds against benchmarks. So they usually benchmark against a fund, and they will tell you what percentage of shares they hold in a portfolio. So they will tell you whether they will tell you if they're an all equity fund. They will tell you whether they're a mix. So you might get something that's between 40 and 85% of equity, 20 and 60, or 0 and 35. So 0 to 35 being the lower risk, 40, 85 being the medium to the higher risk end. If you're going for growth, then, and you've got a longer term, don't do it for a couple of years. You've got a longer term, 10 to 15 years would be nice. Then yeah, you might well pay dividends in terms of overall returns.
Great, thanks. Next question. What is an index tracker, and how can one find the most sustainable options?
Okay, good question. So we've moved on in the business because we love a different term of jargon and terminology. So we tend to talk about passive these days. But index trackers have been around for a long time, and most people will understand because they'll hear it on the news every now and then, talking about things like the FTSE 100 or the FTSE 350 or something like that. That's an index. It's a measure of a number of companies. Quite often, so the FTSE 100 is a measure of the top 100 companies in the UK by financial value. And a bit like the Premier League, every now and then there's a relegation and promotion, and people go into it and people drop out and such like. But the market has got very sophisticated in creating indices which reflect an investment market. So you can have something that reflects the US market or developing markets or whatever else. You can have an index which reflects businesses which are in a particular sector. So you could have sort of green technology companies or oil and gas companies if you were so minded to do so, or whatever else, or healthcare companies or something. So, so it's now possible to create an index, and by creating an index, you hope to have. So I talked about passive and active. Active is about having a person, an actual investment manager, who goes and meets companies, reads the data, makes a decision, decides they're going to invest in a certain number of businesses, and they will buy and sell based upon what they think about that individual company's performance and behavior. And they can be quite concentrated or quite large. A passive portfolio or passive or index tracking fund will create an index. That will be the number of companies that will be there, and you will buy either directly or indirectly through certain techniques enough shares to reflect the entirety of that portfolio. The idea being that you should probably have a little bit more averaged performance. You should, if the index is what we measure our performance against as an active investor, then you should always be getting, a kind of a median type investment performance. It is much lower cost to do that, and therefore it's quite a cheap way of investing. And there are now a lot of passive investment portfolios which incorporate SRI, socially responsible investment, ethical considerations, to varying degrees. So again, it's about doing the homework. Are they excluding something? You can't exclude too many things from an index, because then you haven't really got an index to track. So if you take everything out, it's very hard to measure against it. So there probably is more room for what some people might find sort of questionable investments. But again, using very, specific indices, you might create something which is, exactly fitting your objectives.
So that leads on to the next question then. How easy is it to obtain up-to-date full holdings lists for funds in order to scrutinise how ethical or sustainable a fund is? So how can they get under that bonnet and see exactly what's there?
Yeah. So I think when you're making an investment, you quite often go on. Well, you've got two ways. You can either go directly into company websites, or you might go on to via platforms. There's various investment platforms which will give you data. When you go onto those platforms, you'll probably find a fact sheet. The fact sheet, as I said earlier on, will give you generally the top 10 holdings and geographic spreads and such like. That is the generality of how investment funds communicate. It is up to them as to whether or not they tell you any more about their holdings. Some people don't like to do it or some companies don't like to do it because they think there's competitive advantage by not telling competitors where they're making their gains, hopefully. But it would be in terms of they're not obliged to disclose, so it really is going back to the investment provider's website and looking for a list of holdings, and there are a number of companies in the sustainability field who will definitely provide you with that full list. As I said earlier on, the list is one thing. You've then got to actually have a look at it and see, how you think that makes up with how you want to invest. But I'm afraid there's probably no easy way. And if you go for, we were talking about passives, if you go to find a passive, then you could end up with an Excel spreadsheet, which is running to, a couple of hundred different companies.
Yeah. Could end up giving you a lot of homework.
Yeah.
Okay, next question. Is there a way to protect yourself from any potentially risky investments? So I'm imagining these are kind of like dodgy investments, or just places where people shouldn't go. And I know there's a lot of kind of controversy around crypto and whether it's a good investment or not. But I suppose it's kind of in that field. What would you say?
Yeah, if it looks too good to be true, it probably is, and that's a pretty decent, basis to go on. There are a number of things. One, there are regulated funds, which are regulated by the Financial Conduct Authority. That, in a way, gives you some degree of protection. So they're generally protected by the Financial Compensation Scheme, Financial Services Compensation Scheme, which protects your money up to a sum of £85,000 in many cases against malfeasance and inappropriate behaviour by the investment managers. It doesn't protect you against losing your money because the stock market has fallen down. It just protects you against wrongdoing in terms of that. Particularly for big claims are understanding what is a reasonable rate of return is a useful thing. If you see something that is offering you 8 or 10% and repayment in 3 years, it's very risky. There can be legitimate investments. I mentioned social impact investments and such like. You will sometimes see development funding being requested, and those rates are the sort of thing that can be quoted. But they're if you're getting that sort of figure, it's reflecting the rate of risk which is associated to it. So all those old adages about not putting all your eggs in one basket and such like. But essentially, I think the best way is for your main capital funds that you've got to invest is go through traditional sources, whether that's a regulated platform through regulated advisors or going through banks and building societies and such like, and placing your money into investments which have a financial services compensation scheme protection, not being too greedy, being aware that a high rate of return or a figure that is quoted over a relatively short period of time. If it says, in the last year, 18 months we did 19% or something, it might well have done. If you invested in Tesla, it practically went straight up in the air, in terms of, the chart just went, like that. But that came with a lot of risk as well. So you need to, in a way, they seem quite simple, but then I still get people phoning me up and saying, the Irish Lottery have told me that I've won £1 million and they just have to send in a form. Should I do it? So and they're perfectly sensible, rational people in general. So there's that sort of, you have to sort of talk to yourself and say, is that right?
Yeah, they're more and more scams out there, aren't there? So
there's a lot of scams. There's an awful. It's become increasingly more in the period of post COVID and such like. So it's a sad, really world that people do that.
Yeah. Okay. Next question. Where can I get a good return on savings? My ISA isn't worth anything anymore.
Okay, well, there you go. With inflation at 10% and most interest rates on accounts being between sort of, 0.1 to maybe 1.5% or something, it's hard to make a real rate of return at the present time. Hopefully that's a relatively short run thing, that there will be measures, fiscal and otherwise, to address the inflation over a period of time. And unlike many advisors, actually, I think that cash does have a place in most people's investment portfolio, and I think that you can make a reasonable rate of return. It depends what you want to do. There are best buy tables. We produce them for clients. I talked about institutions like some of these people that seek to get good money as a best buy tables. Instant access will always pay you less because you're giving the company no freedom to do anything with that money. So what you can do, if you want to hold cash, or if you've got a need that you need in a relatively short period of time, 3 to 5 years or something like that, then you could create a portfolio which is a combination of fixed interest deposit accounts. And one of the ways you can really maximize that is to have sort of a tranche in a 1-year account, a tranche in a 2-year account, and a tranche in a 3-year account. That means you're never more than a year away from a maturing policy. So if you have a need, you can go and spend it, but then you can actually take that money back again and recycle it into a longer rate account, so a 3-year account again, which actually over a period of time leverages up the rate of return that you can get over your money. You need to be a bit disciplined, and you need to know that you don't need the money, but it's all about, with cash and deposit, it's about how long can you lock that money up, and managing your need for the resource. I don't put money, or really recommend people putting money in cash ISAs these days. I mentioned earlier on, if you're a basic rate taxpayer, you can earn £1,000 a year on interest tax-free. So it's about looking for a savings account. The other thing is, look, if you save on a regular basis, look for regular savings accounts. There's people like Ecology Building Society who have a good regular savings account package, so that if you're putting £250 a month away or something like that, or up to that every month for a 12-month period, then they'll give you a better rate as well.
Great. Really good. Thank you. I've got 4 more questions, so
okay.
we're nearly there. And it's just starts to rain as well, so we can hear the pitter-patter of rain on my roof right now. Okay, right. Last couple of questions. So I'm 10 years from retirement and have inherited some money. Do I add it to my existing pension fund, or should I invest elsewhere?
Okay. You need to plan what you're planning, where you're going to. You're at a stage where you need to plan. It doesn't have to be hugely detailed, but you just need to sit and think, okay, what is my timeline? When am I going to want to retire? What am I going to do with this money? Is this money that's going to help me live? Is it going to be giving something money that's going to help me do something a bit more flexible? Will I phase my retirement, for example? Will I want to be able to have some money to spend because I want to travel in 6 or 7 years, or whatever? So your decision about where it goes should be driven first by what your plans and your objectives are, and thinking about that and what the timeline is, and then by having a look at what the options are for you. Often, if you've got a workplace scheme, that will generally be quite a good place to put it in for a pension scheme, because it may well manage risk, as so it becomes less volatile. You have less risk of loss as you approach your retirement age. You call it a lifestyle strategy or a glide path that reduces risk as you approach retirement. You will get tax relief on the money. So if you have £10,000 and you put it in a pension scheme, it comes to £12,500. So what's not to like? That's a good way of because of the effect of tax relief. You need to check certain things around what you put into a pension because of income allowances and such like. But you need to accept that money's locked up, and it will only come back to you as up to 25% tax-free cash, and the rest as a taxable income. So again, it's thinking about how you utilize that money. If you want greater flexibility, then yes, you need to look at other alternatives, things like ISAs, 10,000, that sort of thing, or investment portfolio, which might give you more flexibility over when you access capital. Also, think about paying off debt. What's the best way to plan for your retirement? Get rid of your liabilities. Then you haven't got to shell out some money to pay for an ongoing mortgage or whatever else. So it's not all about investing. It's also about thinking about paying off liabilities.
Great. Yeah. And that's something that I think people forget. So that's a good tip there. So last one now from the public.
Okay.
How do I switch my pension to a more sustainable one? And what are your top recommendations for an ethical pension, particularly in terms of their climate change policies?
Okay. Again, I'm a regulated advisor. I have to couch some of these things in not so easy terms. There are more considerations. It's not just, that looks like a nice glossy brochure with lots of pretty pictures on it and people doing positive things and wind farms, and so I'll switch it over there. First, examine your existing pension scheme. Does it have options within the existing pension that offer you a more climate-related investment option? So that's always a possibility. That will be the cheapest and easiest way for you to deal with things if there's suitability there. Then you need to actually compare eggs with eggs and go, okay, well, what's the cost and the charges of this existing plan, and what are the cost and charges of going into something else? We can't guarantee that investing sustainability in a sustainability fund will give you greater returns. We hope it will, but you should really look at what are the core costs and say, if everything's equal, am I better moving it into a new plan? Kind of rule of thumb, the older your existing pension is, the more expensive it's likely to be. Pension charges have changed significantly over the last few years, so there can be merit in moving older pensions anyway. All the aforementioned points about looking at investment funds and solutions, you really need to dig in and actually understand what the funds are doing. What you need to remember, though, is there's a differential between the provider that will offer you your pension sometimes and what the actual fund is. So most people have one or more choices of where your money's going to, and in many cases with big company platforms there will be hundreds if not thousands of investment choices underneath that. So the pension provider is often just the administrator who's offering you the wrapper that allows you to do something in terms of the pensions regulations to run it. So it's not always quite as easy as doing that. There are people obviously that package themselves up and promote themselves with relatively simplistic, propositions to transfer. There are a number of robo-advisors, so online type investment advisors, who probably have perfectly good investments, many of them passive, like we spoke about before. So again, it's understanding what they do, and the issue of transfer is that it basically one company has to talk to the other, and if they use one of the technology-based platforms which is around, then generally they can transfer the money relatively quickly. But you have to sell out of one pot and move the money over to another, so it can take you 3 or 4 weeks or so at least to actually do that. It's thinking about where the money goes. So I'm sorry, people want easy answers, and it's not just because I want you to come and speak to me. It's because I really just want people to understand that sometimes it's not that straightforward. You just need to actually sit and look at that and take those cost considerations in, and then just sort of understand exactly what you're aspiring for that investment fund to do and whether or not it is meeting the objectives in terms of that. Beware of the pretty pictures linking to the Sustainable Development Goals, which sometimes have an interesting way in which they're linked and addressed. Yeah.
Well, that's it for the questions from the members of the public, and such brilliant answers. Thank you so much, Julian.
Shall we?
Last couple of questions for you then.
Mm-hmm.
And then that will be it. You've been so great. Thank you. And
I try.
We're nearly at the end now.
Good.
So, what are your golden financial rules to live by for anyone with any amount of money?
Okay. Plan positively for the future, but beware of potential adversity and provide for that as well. So I always speak to people who have got very rosy glows about life, but I've been advising for long enough to know that people die earlier than they expect, fall ill, leave families in adversity, etc. It's very boring to do life assurance, to put a savings in there, to have a savings. I think in these days we live in increasing ages of precarity, the way people work, etc. Having it's about financial foundations, having a nest egg to give you emergency funds, thinking about what happens in the event of you not being able to achieve your dreams, at the same time as planning positively to build and spread your investments as well.
Great. Okay, and last question now, and it's one that I'm starting to ask everybody, because it can be really hard when you are concerned with sustainability and protecting the planet and stories of climate change, nature loss. How do you remember what's good in the world right now? What do you do? Do you have any kind of habits or rituals, or just ways that, you remember that things aren't all bad?
That's a really interesting question, isn't it? And I think it's, we can get so caught up in our day to day. Yeah, I mean, I think actually it's often talking to people, real people, face to face, putting down the Twitter and the social media and just engaging. I'm lucky. I live in a part of the world that's quite close to the countryside, and I can go for a walk. I can literally go out my back gate into some woods and remind myself about the beauty of the world that we've got, and the luck that we've got there. But actually, I think it is just actually talking, engaging to people. I find my clients are often a source of inspiration. Some of the things they do, some of the areas that they're involved in a way I don't always feel I'm not worthy sometimes, because I probably don't do it, I think, enough myself. But then we have people in the COVID crisis, people were phoning us up asking if we were okay. Wow. And things like that. So people cared about the business because they cared about what we did and such, like they were engaged with that. So I think I think it's just taking cognizance and taking time to engage with people on a human aspect, on a human level, rather than what my job is or something like that.
I love that they checked in on you and asked if you were okay. I feel like we need to ask each other if we're okay a bit more often. So that's lovely.
Yeah.
And that brings us to the end. Thank you so much. You have given so much valuable information. It's definitely one of my favourite conversations. I think you're going to add so much value to the people watching. So I really appreciate it, Julian, and I hope we can keep talking into the future.
Yeah, no, definitely.